Welcome to This Week in Local, a Locology podcast featuring lively conversations about the local digital ecosystem, hosted by Locology analysts Mike Boland and Charles Laughlin.
Hello, everyone, and welcome to This Week in Local. I'm Mike Boland, and my guest host today is David Arslanian, who's Managing Director of Progress Partners. So, David, welcome to the program.
Thanks for having me again.
Yeah, I should say not welcome to the program, welcome back to the program. So, David, you're looking at a lot of happenings in this week's news cycle, and we're going to talk about a few of them. So first off, you're seeing a trend around sort of the fall of and challenges posed to the great regional banks of the United States and some pretty big sort of implications that follow behind those. So tell us a bit about that.
Yeah, I'm watching. It's really still a fallout from when the banks or when a set of banks collapsed months ago, which precipitated really what everyone was fearful of, which was sort of a real nuclear winter among the banking system. It turned out to be less severe than we thought, but it's still precipitating today. We can see it happening today. So that's what I've been following, especially among the regional banks.
Yeah. So one of the challenges here, it seems, is that their sort of, net interest margin, which is, of course, a key sort of KPI in banking, those margins are sort of getting squeezed. And it's sort of counterintuitive because usually when you see interest rates rise, that benefits banks. So can you explain sort of what's happening here in that sort of, arbitrage game that banks play between, attracting deposits and loans? I mean, is there a lot of competition on the deposit side, so they have to offer competitive rates, or is there something happening on the sort of lending end? How are those margins getting squeezed?
Yeah, this squeezing of their margins really, it actually has a effect, which I think a lot of listeners will care about, which is the lending ability then of the banks. So banks, it seems very obvious, but they lend money at a rate which is high enough that when they take in a deposit and that's low enough, the interest rate that they pay on that deposit, you have an arbitrage, you have a spread between those two. And so typically in a really healthy environment, that for the banks anyways, that spread is nice and comfortable. It allows them to take riskier loans. It allows them to be more aggressive in their lending abilities. And what's happened right now with the rapid increase in the interest rate environment, and then the pullout of a lot of deposits, we've seen that arbitrage just totally collapse. And so what you're getting is a lot of risk now in the regional banking systems, where those are the folks that tend to rely the most on that spread. Huge banks don't care as much about the spread, or they are so large that they don't need to worry about it. But at the regional bank level, it matters. And this is where you're going to see them start to struggle.
Yeah. Now, is this sort of, I don't know, not a sign of the times, but just sort of like a Darwinism at play here, not for any one particular bank and their ability to manage risk or their success, but just the category as a whole? When we're looking at regional banks, it seems like it made a lot of sense at certain times where you have small businesses, you have others that sort of need to walk into the bank and get vetted and go through that process of sort of getting their business funded. And of course, those factors and those variables still exist today. But you also see a lot of sort of online only banks that are advantaged by sort of lower cost structures, lower overhead, buildings, employees, all those things. That's why you see some of those like high yield savings accounts offered by online only banks. They can afford to do so. So what is the challenge? What is the fate of the this class of banking?
Yeah, this is a great time. I mean, as a economist, in a free market, this is great because it really presents a tremendous opportunity for other banking system changes, like neobanks, new banks, to come into the market and provide services, better interest rates. It doesn't matter. They're not encumbered by the history of a regional bank that owns, a lot of, as you pointed out, asset classes like land or real estate or, anything. So it's exciting, I think, from that perspective. Where we're going to see a little bit of challenge, and I'd be interested to hear if you've heard from any of your local businesses that you hear from, but we're hearing that it's actually a challenge to get loans right now for small and mid-sized businesses to get loans, and it's just it's a sign of that tightening of the lending environment. But again, I think this is all just, if you look at the tail of what happened from the collapse of Silicon Valley Bank and First Republic as the two sort of marquee ones, this is the tail of that.
Yeah. Now, what were some of the factors that sort of, spiraled from that? Was it sort of, trust in terms of they're getting fewer deposits because of that sort of consumer trust, or again, is it which side of that equation is the culprit here? Getting deposits, the lending side? Is it both? Is it just does it go back to that erosion of some of the consumer trust that it's going to take a while to kind of rebuild?
That's a great one. I believe a lot of that is on the trust side. You're right.
Yeah.
The side that I'm fascinatingly sort of seeing improving right now, which I didn't expect so fast, is we're seeing a ton of businesses move into a very cash flow positive. It used to be growth at any cost. A lot of businesses we're seeing now, they swung in the other direction. They said, forget it. Like, we're going to start generating cash. And those are ones where they had a lot of venture investment into them. And now they're saying, let's swing to cash flow positive. And now we can look at a more traditional loan. And then these are the ones that we hear are going out to the banks or they're saying, well, who do we go to? Silicon Valley Bank was the most sort of well-known debt lender for smaller institutions or smaller corporations rather. And they're not there anymore. First Republic was an up and comer. They're not there anymore. You're not going to Chase for a $500,000 receivables loan for payroll. Like, it's just not what Chase does. Yeah. And you got to go back to these regional banks. That's where you typically got it from. And their lending has become so tight that it's challenged for them to get it.
Well, the interesting sort of ripple effect there is how companies, whether they be startups, whether they be small businesses, sort of structure their debt to equity ratio. Because, in the past, that could be something that you sort of devise strategically. Now it's something that you just may be forced into a certain ratio because of just the availability of those sort of that available funding and what class it's in.
Yeah, we'll see. I think that this is where we're going to see banks take advantage of that. They have to right now because, as we talked about, that net margin spread is it's like that right now. It's non-existent for the most part. They have to get used to operating in this new world. They're going to have to make loans that are just more stringent or to their favor, for lack of a better word. And I also think that we'll see new bank. This goes back to your other statement there. You said it, like, we'll see new banking platforms come up. The U.S. is a great market for banking. It's one of the, as I think it's one of the few in the world that has thousands of banks. Tens of thousands of banking licenses versus most other countries that have a handful. It's a real discrepancy, and the benefit of that is supposed to be to the consumer, so that the consumer has more choices, more options. Well, let's see it. Let's see it play out. I think if I'm a betting man, the next 6 to 24 months, we'll see some new innovative companies come into the market, and some probably larger ones that we will expect.
Well, that's a nice sort of tee up and segue into our second topic here, which is, you used the word neobank before, like the ultimate neobank is starting to become Apple. So tell us sort of what's going on there.
Shocking. Yeah, I'll tell you, I was not a believer in the Apple banking system or Apple banking future. Let me put it that way. I just never thought that they were going to go whole hog into banking because a lot of people see banking as sort of for the large tech companies, anyways, they saw it as a third rail
Yeah.
because it exposes you to a different level of the government. If you sort of think about it from their perspective, they're like, we don't want to fight with all the different, we fight with the FCC. Why do I need to fight with the SEC? Another three-letter acronym, right?
Right.
And that is that's their challenge. That's why I sort of believe that I said Apple will never get into banking. I think I'm dead wrong now. I think quite the opposite. Just if you look at their trajectory and where they've been or where they're going, they're getting into almost every facet of banking outside of actual lending.
Yeah.
But I would not be surprised to see that next.
So let's start. Let's actually back up. The short history of Apple's forays into banking, right? They probably started with Apple Pay, or it may even go back further. Tell us about a few of those sort of components and how they've sort of flowed from each other.
Yeah. So Apple always saw the phone. I think this was even back in 2015, 2014. Apple was launching Apple Pay, and they knew that was coming. Even before that, when they really started the phone, I believe, anyways, as do many others, that Apple had a vision for effectively a wallet. Someday they believe they'll have your ID, really embedded in your phone, and I could see that, right? And that the credit card was a natural extension of that, right? And that cash was a natural extension of that. But to be clear for most of the public, so that that's really different than a bank, right?
Yeah.
A banking system and a banking license in the US is totally different. Apple was relying on the rails of MasterCard, and I believe they still do, to do all of their transactions, right? So they never had their own. So for listeners here, just know where Apple is going is very different than where they've been. Where they've been is just it's on the rails of someone else's platform. It was very easy. Anyone can do that.
And if you look at, I was talking earlier about the high yield savings accounts. Apple now offers one of those, and they do so basically through Goldman Sachs. So it seems like they are certainly taking sort of a partnering approach to get there. And you're right about banking licenses. It's sort of a double-edged sword. You mentioned that they are more voluminous than in other countries, but they're still not easy to get. Lending Club actually recently got a banking license, but they did so through acquiring an existing bank. Sometimes that's the route to get there. And if anyone has the cash to sort of buy a bank, it would be Apple. I'm not sure if that's advantageous for them to do so, but you're right in delineating these sort of types of services. Now, another question that sort of comes to mind here is the why. We always like to ask the why. And we see sort of a pattern when it comes to big tech based on the fact that these companies are so large, sort of the law of large numbers kicks in terms of maintaining revenue growth gets harder and harder to do the larger sort of revenue base you have. So you see these companies, in order to sort of continue to feed that beast, they have to shoot for massive targets. And then you see things like Amazon going into healthcare, Apple going into entertainment. Apple actually just announced its Q3 earnings. It's everyone else's Q2, but it's Apple's Q3. And they announced 1 billion subscribers to their various collective services. That's Apple TV, iTunes, and all these other things. And it now represents somewhere in the 20%, I think it's around 24% of their overall revenue. And interestingly, the reason they're doing this is diversify revenue in the face of the maturation of their cash cow, the iPhone. And if you look at, I looked at the numbers the other day, the growth in services that they reported actually more than offsets the the declines they're seeing for the iPhone. So it's doing its job as a sort of diversification vehicle. So anyway, that's sort of the name of the game. The reason I bring it up now is it seems like banking could be another one of those massive targets they're going for in order to continue growing at that massive scale. Would that be a fair sort of assessment of at least the motivation here?
It is, and let's look at that too from the perspective of what I said, which at the beginning, which on Apple, which was this started in 2014. It's a decade later.
Yeah.
Like it's been a decade since they launched conceptually, anyways, the beginnings of a finance, or bank like object within the Apple ecosystem, and it is now starting to take the shape that probably it will end up in. And to your point, if they end up buying that banking license from someone or getting one, it completes the circle. They're fully in it. Like that's it for them. And it gets back to the need for these large tech companies to service larger total addressable markets, or TAMs, that are capable of generating billions in revenue. Like that's where they need to aim for. It just amazes me though that Apple was, they were a hardware company effectively, and you can say what you want about it, but they are transitioning to a subscription company, and really a platform, of different services for the consumer. Like that is just amazing to me that they've been able to make these different leaps. And, that's why I'm a believer now. I wasn't a believer 10 years ago. I knew the complexities of the financial system, and I said, there's just no way, or it'll take them too long. And someone had that vision for a decade later.
You're right. That's like a multi-year, like diabolical master plan. And one thing this reminds me of, additionally, is that we talk a lot about super apps, and we're hearing a lot about super apps because of Elon Musk's sort of obsession with this sort of principle of the super app. And we've talked about it on past episodes of this show, that it's really the holy grail because it gives you a few different things. It gives you sort of the stickiness, the recurring revenue, the large addressable market. And no one's really been able to do it in the Western world yet compared to some of those super apps we see in China, such as WeChat or, others like that. It's interesting. I always say that, the springboard to get to a super app, which is not easy to do, is to nail the sort of payments and fintech parts first. Because usually those super apps have some sort of transactional capabilities. And that's the hardest thing to pull off. I mean, there are social aspects, there are e-commerce aspects, there are communication aspects when you look at things like WhatsApp, which I think is going for that sort of super app strategy. But I think the starting point is often sort of some of these fintech elements. And if you look at, maybe it was unfair to say we haven't seen a super app in the Western world. Maybe the super app is your iPhone. Your iPhone home screen is the super app essentially. But Apple going more towards some of these sort of banking and payments sort of foundations for this make a lot of sense, and sort of tying together that like one touch point that really just sort of increases the revenue per user on a day-to-day basis. You're just more of a touch point to Apple and their products when they're doing just more of these things that serve consumers on a day-to-day basis. Entertainment, hardware, computing, music, podcasts, and now your personal banking. It seems like it fits right in.
Yeah, it really does. And a lot of people are probably like, banking, entertainment, huh? But you got to get to the root level that they're playing at, which is the connectivity to the individual, right?
Yep.
And that they have basically found a way to connect to that individual on a level that makes that individual, going back to our original thing about trust, right? Trust the platform in order to use it.
Yep.
Banking is foundationally a trust driven, right? You put your money somewhere, you probably trust that person, right?
Yeah.
You trust the bank or the institution, right? That's a lot. That's saying something, and that's what I think what Apple is doing. That's the game they're playing. I also believe on you know this, we all know this. Financial services is one of the most lucrative markets you can
Mm-hmm.
be in just all markets, right? Financial services is it's just the general margin profile of, if you look in the aggregate, right? It's really good.
Yeah.
That's why people tried to break into it many times and have succeeded or failed. It's why actually, I mean, Elon Musk, for all of his, failings in the Twitter acquisition, which I believe he did not want to do at the end of the day. I
Yeah.
believe that. But I believe that his default position was, I'm buying a ton of users, which I
Yep.
have an immediate connection to. And if I can get them to do the pay, because remember, he's a PayPal guy
Yeah.
at the end of the day,
Absolutely.
right? That's where Elon came from. And so even if you don't think Elon was the one that did the PayPal shit, right? It's like, sorry, even if you don't think that, he still has that in his mind, like, oh my God, that made so much money. That was probably the most lucrative thing he's done, right? Compared to the low margin Tesla, the low margin boring company. Like, this is a high margin area. And so even if he fails at the acquisition, but he somehow retains the users in this transition to X, quote unquote, as a payments platform, he might only have to retain 10% in order for this to be a profitable outcome for him. Like,
Absolutely.
the math is stunning when you think about it that way.
Yeah, and when you look at financial services as one of those, giant markets, you're right. And there are really only a few of them. There's healthcare, there's financial services, there's, autos, there's travel, there is just these massive things. And, those are a few of the dominoes that have fell when you look at, where Amazon is going, where Apple's going. So it really makes a lot of sense. I guess, a car company is and Elon did that, right? So I mean, that's they're all in that list. So let's now transition into our Who Won the Week segment. So David, why don't you tell me who you thought won the week?
Yeah, I'm probably not coming up with something really too original here, but I'll take a little twist on it. So, like everyone, Barbie, the phenomenon that is pretty amazing. I'll lump Oppenheimer in there as well, and the reason is because it's the movie goers. I think that won the week this week, as Barbie surpassed $1 billion. It is getting close to rarefied air of, I think it was the Avengers Endgame movie. There's the largest grossing of all time in the movie theater, and it just goes to show you that movie theaters are coming back along with their viewers. I'm not saying it's here to last, but what I am saying is it's a good time to be a moviegoer again. People are excited to get into the movie theater. That shared experience still seems to be desired. And I did not necessarily believe that 2 years ago, mid-pandemic, that was going to be the case. But it's good to see. We need things like that for social.
It's good to see some of these IRL things coming back. Movie going. I saw a headline the other day that even Zoom is forcing its employees, the company, to come back to the office, which was just a kind of nice moment of irony and moment in time. But anyway, my who won the week is actually Yelp. Yelp announced its Q2 earnings recently. Really strong quarter, but that's not why I'm naming it as my who won the week. I was sort of digging through its earnings results, and one thing that jumped out is that the share of Yelp's revenue that is coming from what it calls cost-efficient channels is now up to 51%. So I'll give you an example. A big chunk of that is self-service revenue. So it's small businesses that basically raise their hand, they onboard, and they do it all themselves. Whereas sort of the previous paradigm for Yelp was the majority of it was something that is sold. It is now a product that is bought, not just sold. And the reason that's important for Yelp is that it's just a much higher margin product. Just the unit economics work out a lot better because it's a lower cost of acquisition, not a salesperson required. But number two, I think more importantly, Yelp tells me that this cohort of self-serve advertisers actually churns at a much lower rate. And it stands to reason why, because there's a stronger demand signal when they sort of come forward and buy something as opposed to if they were sold something. And then also not just the sales and the procurement, but the actual fulfillment, their daily engagement in their sort of hands on the wheel in terms of managing their Yelp presence and seeing the tangible ROI firsthand just sort of keeps them invested and aware. So I think it's a direction that Yelp is going to continue to go in. When Yelp was on our conference stage back in San Diego, a show that you were at, David, they actually said that they were moving in this direction. It was a strong initiative for them to sort of give their sort of their UX sort of a makeover to make a more robust, self-serve, accommodating sort of workflow. And it's very cool to see in their earnings that that's actually bearing fruit. So for that reason, I think that's very cool. We're going to continue seeing what they're doing there.
Yeah, it's a great area. I love that one as well. Never underestimate the small businesses in the United States. And I'm also happy because I think that's indicative of that aspect of the market really starting to heat up again, which that portends to a good sign.
Yeah, and people not only going out to the movies, they're going out to dinner. They're doing all the things that they need Yelp for. So several levels, that's a cool one. So we're going to end it there. Thank you, David, for joining us. This was fun.
Thank you. So, as always, and look forward to doing this again sometime, as well as the next conference.
Yeah, absolutely. So thanks everyone for listening. This has been This Week in Local. Stay tuned every week for more episodes. You can find the show on all major podcast networks and find out more at locology.com. Please subscribe, like, and comment. Your engagement helps others find us. So I'm Mike Boland. My co-host is Charles Laughlin. Our producer is Dara Sweat. And this week's guest host has been David Arslanian. You can find out more about David and Progress Partners in the show notes. So thanks for listening and see you next week.
Thank you for tuning in to this week's episode of Locology's This Week in Local with Mike Boland and Charles Laughlin. Be sure to subscribe for more.